Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
What's up, everybody? This is Kevin with the Tech Guys Who Invest. On this episode, Adam and I had the pleasure of interviewing my friend John Casmon. And I met John at a San Francisco real estate summit, and we connected, and I've just learned so much from him. So I'm thankful that he was on our show, and we got to pick his brain about what he looks for in a market as a multifamily investor. John Casmon is a real estate entrepreneur who controls a portfolio worth over $58 million as a general partner. He started by house hacking a duplex and now partners with investors to purchase apartment buildings through his firm, Casmon Capital Group. He is the co-creator of the Midwest Real Estate Networking Summit, a no-pitch event to connect like-minded investors. John also hosts a weekly real estate podcast, Target Market Insights, where he speaks with specialists across the country to uncover the best emerging markets, marketing tips, and investing insights. With the background in marketing, he has overseen campaigns for General Motors, Nike, and Coors Light, amongst others. John was even recognized by Black Enterprise magazine as one of the top executives in advertising and marketing. So without further ado, here is the interview with the Tech Guys Who Invest and John Casmon. John, thank you so much for being on our show. We are absolutely excited to have you on. So thank you so much for your time.
Kevin, thank you for having me on.
Now, I know you asked this question on your show, and because we are Tech Guys Who Invest, we wanted to flip the script and ask you to give us a digital or mobile resource that helps you with your apartment investing and syndication.
That's a great question. Dropbox is the first thing I'm going to say. It's a great platform just to share pictures, documents, things like that. I also use Pipedrive. So it doesn't have to be Pipedrive, but a CRM system where you can stay in touch with all the great people you meet. So for us, obviously, apartment syndication is all about putting deals with capital. And it's really done on a one-on-one basis. So we meet a lot of investors, a lot of folks, a lot of brokers, and we just try to manage all of those relationships and conversations to know where we need to follow up. So some sort of CRM system, we use Pipedrive, but Contactually is out there, Salesforce, there's a lot of other ones, but some sort of CRM system.
Great. That sounds good. John, I know that you invest in apartment buildings. I was wondering if you could tell our listeners a little bit about you and what you do there and what that looks like for you.
Yeah, absolutely, Adam. So for us, we invest in apartment buildings. The way that works for us from a syndication standpoint, like I said, is we work with investors. So we're taking the investors, we're working with their capital, and we're pairing that with deals that we think are great for them. For us, it starts with building those solid relationships, understanding what investors are looking for. And then for us, when we look at different deals, it's making sure that we start with their returns in mind. I think the big difference between anyone who's buying multifamily, whether they're buying it for themselves versus buying for a group of investors, is when you buy for yourself, you buy for your own returns. You buy based on what you like and different things. But when you buy for investors, the first metric you're going to look at is what is the IRR, what is the return for them. So that's one of the big differences. But we do that. We just closed on another property last week, or about 2 weeks ago, actually, and added that to our portfolio. It's our first property out in Florida. We're general partners on that. So we partner with another operator who's the lead. They oversee the day-to-day management of everything. And then we partner with them when it comes to things like investor relations, marketing, market research, just really understanding another POV. But we do a few other things behind the scenes to advise them on what our investors are looking for, and we'll give them recommendations on how to operate the asset.
Fantastic. So there are a couple things that I wanted to kind of rewind and unpack there. You said IRR, and for our listeners, some of them may not know what that is. Yeah. Can you explain that acronym and how that's valuable to an apartment investor?
Yeah, absolutely. IRR stands for internal rate of return. And basically what you may hear is cash on cash or something like that. What IRR does is it basically calculates the time value of money. So let's say, for instance, you invest $100,000 in a deal, and you double your money over the course of 5 years. So you make 100% profit. You invest $100,000, you get $200,000 back. Same cash on cash return. The difference with an IRR is it values how quickly you get that $100,000 profit back. Do you get 50,000 year one and then 25,000 with the balance coming out slowly at the end? Or do you get nothing for 4.5 years or for the first 5 years? And then at the end, when we sell the property, do you get the $100,000? So it basically values the speed and velocity of your money. So a lot of sophisticated investors really lean more towards the IRR as opposed to a cash on cash because they want to value how quickly they're getting their money back.
Okay, that makes total sense. There was another term in there that I think you used, if I'm not mistaken.
Okay.
I heard POV. Is that what I heard? Or maybe
Yeah,
not.
so like a point of view, right? So you're saying that with the
Yeah.
partners that you work with, it's just another set of eyes as to how they look at it.
Gotcha.
Yeah, exactly. Sorry about that. Yes.
No, that's good. That's good. So Casmon Capital, John, what is that?
Yeah, so that's the firm we have to do our apartment syndication. So that's our firm. We work with the investors as we talked about before, and then I mentioned how we partner with other operators. We also do everything kind of ourselves as well. So we operate where we find a deal. We will bring our investor database into the deal. They will oversee the management and execution of that asset.
Nice.
Yeah.
Now, one question that I have about the investors that you were talking about, the rate of return, what do you do when somebody wants 8, somebody wants 12, somebody wants 22? How do you kind of incorporate that?
Well, everyone wants 22 and 30 and 40 and 50, right? So, I mean, it comes down to, a deal's a deal, right? So what we're doing is we want to gauge what people are looking for so we can understand whether or not our risk tolerance is aligned. Sometimes you'll meet an investor who is looking for more risky deals. And by more risky deals, what they really want are greater returns. And for us, we have a model where we focus on value add investing. So we're only going to take so much risk on. So we'll know from some of those initial conversations whether or not it's going to be a fit based on the kind of returns that they're looking for. So if anyone's looking for, let's call it 20% and up IRR, they're probably looking for something that has a little bit more of a distressed asset or distressed component to it. And we're not really as comfortable doing that. We prefer more value add plays where it's already 85, 90% occupied. Rents are coming in. There's plenty of capital right now to cover all expenses as well as the mortgage. And what we're trying to do is go in and use more of a business mindset approach and say, okay, but if we do this, this, and this, we can take revenues and the net operating income from this number up to this number. We're not trying to go in and salvage a building that needs, a great ton of work. We've done that, and I don't really care for that much work. It's much easier, and I think it's a better way to preserve capital to focus on properties that are already making money and just find ways to have it make more money.
Okay, that's great. And you've been talking a little about this already, but I'm not sure if we've used the term yet or not.
Yeah.
And some people may not know what an apartment syndicator is. So, John, could you explain what an apartment syndicator is and what they do?
Yeah, you'll hear a couple of different terms: apartment syndicator, you'll hear operator, you'll hear sponsor. But in short, what most people mean when they use those terms is syndication is simply the pooling of assets. That's bringing people together to acquire an apartment building or acquire any piece of real estate or anything, to be quite frank with you. So syndication is really the means of pooling all those resources together. The operator is the person who is actually overseeing the execution. That's the person who is signing his name on the contract. He's getting the loan. He is hiring or firing the property management company. She is hiring the contractor. So that person is making all the day-to-day decisions on the overall asset. The sponsor is the person who is connecting the investor to the deal. So that sponsor is the person who's taking it. They're creating a private placement memorandum. They're issuing it out to these investors, and they're bringing the investor into a deal. A lot of times the sponsor and the operator are the same person. So you hear this language, kind of used interchangeably. But, typically, or some folks, they do, whether it's called like GPs, general partners, or you hear co-GP, different terms like that, or co-sponsor. There are different people who bring those individuals into the deal. But to keep everything really, really simple, just think of it as pooling resources together. Instead of you taking $50,000 and buying whatever piece of real estate you can buy for $50K, and me doing the same, and Kevin doing the same, if all of us put all of our resources together, now we can go out and acquire a larger asset. And because of that, we're getting more professional property management. We're getting more professional contractors, and the ease of ownership, the ease of financing, the ease of operations becomes much easier. So it's a win-win situation. Now, the downside or the drawback is you lose a little bit of control because you do have more partners involved in the deal, but you gain some upside in the efficiencies of the operations where it shouldn't take up too much more of your time once you're actually in the deal, once you've already vetted it.
Okay, so there's an economies of scale factor there where you're buying much larger and more doors, so there's only one roof to take care of, for example. But what you're saying is when you buy that large and you're pooling money, you're now having to not necessarily worry, but consider the other partners or the other investors in the deal.
Yeah, absolutely. You've got to consider them. I mean, think about it. For us, it's our business. So if we do deals or we do business with people and they're not happy, then I have unhappy customers. They're probably not going to continue to do business with me, right? So you absolutely need to understand what people are looking for. And that's why when you mentioned earlier, what do you do if someone has different returns? Sometimes it's on us as operators or sponsors to look at someone and say, hey, listen, I don't know if this deal is right based on what you've told me. If something's changed, let's talk about that. But if you want returns that are not realistic for this deal, then that's not the person you want to get into a deal. If they want 20% IRR and this deal is going to net you 14 or 15% IRR, then we're not really aligned on what this is. So you don't want to get someone in a deal where they have different expectations than what you have of what the deal is going to be and how it's going to perform.
Okay, I like that. That makes a lot of sense there. So you are really like a quarterback, if you will, of the entire operation.
That's a good way to think about it. Yeah. I mean, you have a lot of people in place from the contractor to the property management firm to the lender to all the folks on the execution side and then all of the investors. Your investors are really critical because they're the ones bringing the capital. They are the ones who are also partners in the deal. They're your limited partners, but they have money in the deal as well, and they want to be successful. And as a sponsor, you've got to be careful just making sure that you understand what they're looking for, you explain it to them, because you don't want someone to feel like they didn't know or they didn't understand or they were misled. So we definitely want to make sure you take the time to educate people and inform them on what to expect for the deal. And sometimes deals don't go 100% as planned. You do everything you can to make sure they go as swimmingly as possible, but it's our job to make sure we educate people on what to expect.
Yeah, I really like how you're talking about understanding your investors and aligning their goals with yours and all of that. That's really neat. Kind of a great thing to hear you talking about when you're talking through this. What? Let's talk a little bit about the markets you invest in. What do you look for in a market that indicates it might be a good place to invest?
Yeah, you're looking for opportunity, right? So you're looking for growth. You're looking for places that are seeing growth and development. You're taking a look at demand as well. So ultimately, I'm looking at I'm looking to see what the demand is currently today and what the demand is going to be in the future. So we're looking at population growth. We're looking at job growth. We're looking at job diversification, and then we're also looking at key submarkets. So we want to identify the path of progress. Where are people looking to go? What's driving people there? How is everything performing? And then we're looking at the multifamily sector. So are rents going up? Are rents going down? Is occupancy increasing, or are people starting to buy more houses? So we're looking to see what's happening in that area so we can make a prediction. And we want to make a prediction of what the market is going to be like in the future. And it's obviously tough. None of us have a crystal ball, but we can look at all the economic indicators and paint what we think is a pretty good picture of what the market will look like in the immediate future.
I think I've heard of a fantastic podcast that highlights where you can find local insights from investors around the country.
Yeah, what's the name of that?
Yeah. It's a good one. Yeah, man. We started Target Market Insights about a year and a half ago, I think. And it really started from the notion of trying to find the best places to invest. As I was starting to go out of state for the first time on my own. I mean, I've done it with other partners, but on my own, I just want to make sure we were replicating success. I knew what worked well for us in our market, but I was humble enough to understand that it's great to learn from the people who invest all over the country and learn from specialists, not just investors, but other folks who are doing different things. And that really helped us to just really tighten up the metrics that we use to find the best places to invest.
Now, from that episode, how many people have you interviewed so far?
I think we, at the time of this recording, I think we have 88 episodes live and probably another 8 to 10 episodes recorded. So I would say
Nice.
close to 100.
Now, from that close to 100 investors or so, what are some of the insights that they've given you where you were thinking, whoa, that's a good one. I need to remember that one.
Yeah, I mean, a few when it comes to how to find the best place to invest, right? A couple of tips that really jumped out to me were one, this may not sound over the top, right? But just roll with me for a second here. You're looking for the demand drivers, right? You're looking at jobs, you're looking at schools, you're looking at parks, but it's not just that. The thing that's really important is to look at the next step. What's happening with those drivers? Just because there's a big employer in the area doesn't mean it's a great place. You want to find out, is that employer growing? Is that employer hiring? Is that employer expanding? If there's a great hospital that's a great demand, is it adding a new wing to the hospital? Is it growing? If there's a great university, what does enrollment look like? So taking that extra step is really the aha insight. Is don't just say, oh, well, the university is right there. Find out what's happening at that university. Go read their quarterly report. Find out if the enrollment is at all-time highs or if they're declining. And that's what's going to help you understand what's really happening in that area. The other thing is to find those places where there is a lot of demand and just look right next to it. Go to, best places to live. You can find a lot of great data out there. And instead of focusing on those markets where the press is already writing about it, just look at the next neighboring neighborhood. There might be some great information or some great opportunities to invest there. Another great tip, which is a little bit more practical, was starting to understand the correlation between mortgages and rents and looking at that difference. Because if people can afford to pay a mortgage, then it may be a little harder for them to pay these rent increases. So you want to look at the margins there. Another one that is more tactical is looking at interest rates and looking at the difference between interest rates and cap rates, and looking at maybe a 200 basis spread as far as those two things go when it comes to certain asset classes. So there are a lot of tactical things when it comes to how to evaluate the deal itself. But I really like some of the higher level things when it comes to, hey, here's some basic stuff you can do. Look for grocery stores, look for, um, restaurants, things like that, especially if you're completely unfamiliar with the area. So you can start with that to get a general sense, and then you can continue to drill down lower and lower and lower.
Yeah, you gave us some really great tips there. And one of the things you mentioned was around look for an area where everyone may know about it already. It's being written about, that sort of thing. And then maybe look for an area next to that. I really like that. Here in Florida, we've got a lot of little towns kind of out in the middle of the state, so Kevin and I are located in Tampa, not far outside of Tampa. They're just some little bitty towns. And you do occasionally see some apartment buildings in those little places, but the population's pretty low. Do you have thoughts around investing in an area with low population, and what advice might you give someone who's looking at those areas?
Yeah, I would say, if it's in the Tampa MSA, then I would be more comfortable. If it's really in a rural area and it's not in the MSA, then you have more risk involved there, right? Because there's a bunch of small suburbs and cities and outskirt places. I think ultimately what you're trying to do, and I've looked at a ton of data. I've talked to a lot of people about this, and if I could boil it down to one thing, you're trying to gauge demand. So whatever that means, that's what you're trying to do. Okay. And the way you look at that is, if you're in a really small town, and maybe there's only one big apartment complex in that town, you need to understand what's happening. What's going to drive people there? What's the mindset? Is this a small town where people are looking to purchase their own single family house? What is the household income for the area? How close is it to the high school? Like, what are the drivers? And it's the same principles, but you're trying to measure demand. If population is growing, is there new development in this small town, or are people leaving this small town? So you're looking at all the same information, but you want to make sure you understand the overall landscape. One important thing to look at is net absorption rates. So what that means is, anytime you're looking at areas that are seeing growth, you may see new construction. You may see new housing being developed. You may see new apartments being developed. And a lot of times people talk about, hey, invest in places that are seeing growth. but they don't factor in this other aspect. Because there's growth, that means there's people building new units. So you have to factor that in, because typically they're building new luxury class A apartments or class A units. No one's building cheap, class C, middle of the road apartments. They're building really nice high end stuff, because that's where they can make their profits. So you have to look at your business model and your business plan and say, okay, how many new apartments are coming on? How many new units in total are coming on? And is there enough population growth to absorb this? Because if not, then you're going to be in a situation where supply gets heavy. And it's the old rule about supply and demand. And if supply becomes too heavy, the demand is going to decrease. So even as you're looking at the growth in these markets and all those different factors I mentioned earlier, you have to keep your eye on supply to make sure that the supply and demand is going to be leveled off. Because there's some markets that may not see as much growth, but demand is strong because there's not enough supply.
Yeah, some great information you just shared.
A ton of valuable nuggets of knowledge. I do have a question. You were talking about the Class A, Class B, Class C apartments. When you get an investor that says, John, I saw this Class A, I want to invest in the Class A, but you invest in more value add stuff, how do you handle a situation like that?
Yeah, we'll be pretty much upfront with an investor. If it's not going to be a fit for us, let's say in your situation, someone's focused more on Class A, some might call it a trophy investment. That's not really our style, but I may know someone, I may put them in touch with them. I have no problem doing that, to say, hey, you know what, that's not really our focus, but such and such does. You should reach out to him. He's a good guy. So that's something we will do. Or I'll say, well, look, what is it that you love about that? Do you love the fact that, um, like I mentioned, that it's a trophy asset and you want to tell your friends you've invested in this beautiful thing? Or do you like that it feels more secure? Because the reason we focus on value add is we focus on that strategy because we think it's the best of both worlds. It's an area where we can create value. So we're not necessarily just waiting on the market to drive up appreciation. We're going in and we're increasing the value of the property ourselves through some very select renovations, through a business plan that allows us to decrease our expenses, hopefully increase our income, and overall drive up the net operating income. So we're driving up the value. So, we try to understand what's driving those conversations. And if it's not a fit, it's not a fit. But we certainly want to make sure that we understand what people are looking for. Ultimately, once we have a deal and we reach out to investors with that deal, we do ask them, hey, is this something you're interested in? And if not, then we like to find out why. And then we'll get more clarity on, is it this deal, or, are our philosophies just completely off?
Okay, fantastic. Thanks for sharing that and clarifying how you would do that. Because I think managing those expectations are huge, right? If someone's going to partner up with you, you need to be clear about this is what I do or what you don't do.
Yeah, I think it's important too on both sides, because you can also start easily chasing stuff that maybe isn't in your wheelhouse, or you become like a cat with like the red light, and you're just, oh, well, there's this going on, or that, and next thing who are you and what do you invest in? For us, we invest in class B, Class C value add apartments. Period. I understand self-storage. I understand mobile home parks. I understand single families. I understand fix and flips. I understand them enough, but not enough to be an expert and to feel comfortable taking that on at this point. We could self-storage and mobile home parks. It's not rocket science, but on the same note, I believe in focus. I think that it's really important to lock in and be very focused on what you want to do. And that's the way we approach it. I know a lot of other people who will invest in anything that produces an ROI. So, and that's just not our model. That's just not how we approach it.
Yeah, that's really good that you're focused on that. Kevin and I even did an episode on investor identity, and we talk about focus a lot. So I really appreciate that.
Yeah.
So one last question for you. I hear a lot of people talking about the part of the cycle we're in, and how it's kind of a seller's market or whatever you hear. You hear lots of different things. Any thoughts around that, and how how it affects an apartment investor with where we are in our market cycle?
Yeah, it's critical, right? I think that you can look at it a couple different ways. I know people who are sitting on the sidelines saying, hey, I'm going to wait. What I would say is, by not taking action, that doesn't feel like a very smart way of taking action and protecting yourself, right? What I would say for us and the way we're approaching it is we're being more cautious. We're looking at properties where there's strong cash flow. That's why I like value add, because I can always slow down renovations or stop renovations, just focus on the occupancy. But we like value add properties that are already generating positive cash flow day one. We're looking at markets that are showing strong economic indicators as far as growth is concerned. And then the key is to make sure we finance them correctly, that we are in control of the financing. When possible, we want to be in long-term loans as quickly as possible. If there were a deal that we liked that required bridge debt, then we would look for a bridge to perm option, but and make sure that we stay in control of the renovation schedule. But the upside would really need to justify going that route. So, I think looking at it, trying to find ways to be conservative and recognizing that, hey, we may not be able to generate the 18% returns today. Maybe it's going to be 16% is what we're going to settle for, if you will. And I think that's okay, as long as we recognize that, yes, we may be at a point where the market's hot and it may not ever be this way again. But for a lot of our investors, they don't have very many other options. They do. There's the stock market, and they can ride that crazy wave as much as they want. But I mean, real estate as a whole is doing pretty well right now. And I think part of it is, if you look historical, yes, it's at an all-time high, but I also think you have to factor in a couple other things. One, stock markets are at an all-time high. Right. So, and if you look at stock markets and where that's headed, I think there are a lot of investors who would like the security of a real asset and would be happy to pull money out. Two, you have the recent tax reform, which allowed for us to take 100% bonus depreciation year one. Now, that may not feel like a huge thing if you don't have a whole lot of passive income, but let me paint a scenario for you real quick. If you are a doctor who owns a portion of your practice, or you're a partner in the practice, and let's just say you generate $500,000 in passive income through your K1 statement at the practice annually. You invest in an apartment deal and you are able to take $200,000 as your portion of bonus depreciation. You can now subtract that $500,000 of passive income from your practice, subtract the 200,000 in losses from the bonus depreciation, and now you only have to pay taxes on $300,000 of your passive income.
Wow.
Now, you still made profit, by the way. You still made whatever cash flow distributions from that apartment investment, but because of the K1 statement, the way that deal may work, now you're able to show a loss and reduce your taxable amount. For a lot of high net worth people or people who own a business, they're looking at things like that, which are new developments. So this was not the case 3 years ago. 3 years ago, you had to parse it off over a period of years. Now you can take it all year one. So for a lot of investors, they're not looking at historicals. They're not looking in the rearview mirror. They don't care what happened 10, 20 years ago from that perspective. You need to learn from the past. But the situation today is different than the past. The internet, the Jobs Act, all of these things have made it more advantageous for investors all over the world to invest in U.S. real estate. And in a time where things are very unsteady, I think U.S. real estate is a very attractive option for many people with high net worths across the globe. So that's something that I think is still driving cap rates down and operation costs. And by the way, money is still relatively cheap when you look at the banks and you see that now they're still talking about maybe even cutting the interest rate, not rising it more, but they're talking about potentially having to cut the interest rate. So it shows that the economy as a whole is maybe not as steady as people would like. And it would be good to have your money in a solid, secured asset like real estate, where it's generating cash flow. So I think that there's a lot of things like that that go into it. So I hear it all the time, and I don't disagree with them. I actually agree that it is at an all-time high, and I think that investors should absolutely take caution with that. But I don't necessarily think the answer is sit on the sidelines and wait, because you just don't know what's going to happen. I'd rather be in secured assets and invest in them in a way where, again, even if occupancies dip, and your cash flow is not as great as you would like it to be, you still have a cash flowing asset, and it's done so in a way where you can invest in it and hold on to it long term if necessary, but still deliver strong returns for you.
Nice.
Yeah, so you're effectively, it's secured by real estate, and you're thinking more along the lines of creating a deal as opposed to just finding a deal. You have to kind of structure it so that you are creating that win-win for everybody, your investors, the seller, and yourself as well.
Yeah, I mean, that's what value add really comes down to. I mean, value add, I mean, if you are going in and you just want to buy an apartment building, I absolutely 100% understand why you're saying this is overpriced, right? I get it. When you go in and you're doing a value add investment, you are looking to solve problems for everyone. You're looking to create an opportunity for yourself and for your investors. And that's really the difference. You know, for folks who are not finding deals today, and don't get me wrong, even with value adds, it's tough. It's tough to find deals, even with that strategy. But it takes a little bit of work, and you have to just stick with it. And I think that there's definitely opportunities out there, but you have to be willing to go out and find opportunities, create opportunities, and do so in a manner where you can, you can take care of it. So if you can do that, there's opportunities out there, but you have to solve those challenges, and you have to find those owners who have a problem to solve. And otherwise, like I said, they're deals that we've looked at, and I've talked to owners, and they have ridiculous prices in their head of what they want to get. They don't have a problem to solve. And the problem doesn't have to be a bad problem. It could be a good problem. It could be, hey, we've made a good amount of money in this deal. We want to scale up to another deal, so I want to sell this deal, right?
Exactly.
So they want to convert maybe their investors or their own capital into another deal. Or take what I just mentioned to you about bonus depreciation. If they've already taken most of the depreciation that they can on a deal, they may not see the tax benefits of continuing to stay in that deal, so they may want to roll into a new deal. So you just have to understand the why behind every deal. And if you understand that, you might be able to get a little creative and structure a deal that works for you.
Getting direct to seller is absolutely important. That's the only way you'd figure out that motivation. Yeah. And staying focused with that, I want to piggyback on the idea of focusing on your market, focusing on your niche for your asset class, your investor identity. What are some overrated market indicators that you could come up with, since you've interviewed so many people and you yourself have done a ton of research?
Man, that's a great question. I'm scared to answer that. I feel like whatever I say, I'll get attacked for. So I'm gonna say this with the biggest caveat I could ever give. Okay.
Sure.
I think population growth by itself is overrated. I think everyone goes to population growth first. And I've said it multiple times, but I'll say it again. What you're ultimately trying to measure, in particular, if let's just say we're talking about apartment investing, you're trying to measure apartment demand. So looking at population growth as by itself is a little bit overrated, because you should be looking at overall demand and apartment demand. If people are moving there, but they're buying their own single family homes when they get there, who cares? If they're moving there and they're not moving into the asset that you want them to move into, it doesn't really matter. So you really need to gauge demand. Or if they're moving there, but every other builder is building apartments for them, does it matter to you? No, your numbers are not going to go up. You're not going to be able to drive your rents because there's so much new demand. So you've got to take a look at supply as well. So I think just looking at population numbers without understanding supply is a bit overrated. And I think it's really important for investors to know that.
That was a very fantastic diplomatic answer, so I appreciate that.
Yeah,
Nice
because you can cut up the soundbite, man, and just have me sound crazy out here saying population growth is overrated. Like, wait, what? No, that's not what I meant.
You did have that caveat, so yeah, I like that.
So, John, where can people find out more about you? Where can people find John Casmon and Casmon Capital?
So, education is a big part of what we like to do. So you can check out the podcast, Target Market Insights. It's available anywhere you're listening to this podcast right now, unless it's on your website. Then you got to go to CasmonCapital.com. Another place is, I'm in Chicago now. I'll be here for a little bit longer. And I'm hosting the Midwest Real Estate Networking Summit in June 1st and 2nd. So you can check me out there. You can go to that website, MidwestRESummit.com. Or you can just check out our email, or send me an email, or go to our website. My email is john@casmoncapital.com. And then our website is casmoncapital.com.
All right. Thanks so much, John. We really enjoyed having you on.
Thank you for having me on, guys. I appreciate it.
That's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.